Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is the week ahead for the week starting Monday, the 15th of July, and it comes off the back of a week that started off with a big focus on the French elections, but ended with that downside move in terms of US headline and core CPI, notably seeing gains for equity markets. But we started to see some cracks emerge as people started to essentially move from those big tech names that have been propping up the market and instead moving into smaller names or mid-sized names. So we're seeing a broadening out in terms of the equity market strength. That could be a healthy thing, but it does raise question marks around the tech sector as a whole. Coming into this new week, inflation remains a key theme, central bank decisions remain a key thing, and certainly this week will provide us with plenty of hurdles, albeit it doesn't necessarily have a huge amount of focus on the US. That US focus is likely to be remaining around the earnings season, with the first proper earnings season week getting underway. The big banks reporting once again, following on from Friday's reports, but certainly there's also going to be some other major names coming into play, some health sector names. We've got the likes of Netflix also reporting, so it should be a big week from an earnings front, but in terms of the economic data, really the focus is on other areas, most notably within Europe, but also over in Australia and New Zealand. So let's get into it. First and foremost, this is a list of the big ticket items over the course of the week. So let's quickly go through that. You're going to kick off on Monday with some big data out of China, with the GDP figure expected to decline down to 5%, industrial production and retail sales also expected to decline. So potential weakness in that China growth story once again. We've got Jay Powell providing yet another testimony. This comes off the back of a two-day appearance in Washington with the week just gone. We've got the ZEW economic sentiment on Tuesday, that Canadian inflation rate and the retail sales number out of the US. Then on Wednesday, we've got UK inflation. Thursday, UK jobs report. We've got the ECB interest rate decision. And then on Friday, inflation data coming out of Japan and retail sales from the UK. So certainly a big focus on the UK. But we're going to kick off with the Eurozone, given the fact that we have got that ECB interest rate decision. Now, of course, markets don't expect a move this time around. And in part, that's because, in my mind, they don't want to run too far away from where the US central bank lies. And certainly, there's been this question mark of whether other central banks would move ahead of the Federal Reserve. Typically, that isn't the case because there's so much capital flight to the US as it is anyway. If you have this significant interest rate differential, then of course it does incentivize people to move their money over to the US, causing potential currency devaluation. But nonetheless, with the inflation rate that we have just seen recently out of the US, there's growing confidence that we will see that interest rate cut coming in September. So in terms of what to look at for this time around, we can see that markets are expecting that interest rate to remain at 4.25, similar for the deposit facility, 3.75 expected. Now, in terms of market predictions, you can see just a 5 to 6% chance of a rate cut this time around, according to Icon. But September's where it's at, and certainly that really rings true for the idea that if we're going to see the Federal Reserve cut, then we could very easily see the ECB following suit. And again, that same feeling for the likes of the Bank of England, with a view that they're likely to cut in September as well. So I do feel like that Federal Reserve interest rate cut would almost provide the basis for other central banks to feel good enough about the fact that they're all moving in tandem now, and most notably the fact that we have the US Federal Reserve cutting interest rates as well. So here's a comparison between the main policy rates at some of the dominant central banks. And what's notable here is that, as you can see in that orange line, we've already seen that interest rate cut from the ECB. But the ECB, given the fact they were in negative territory where this whole inflation crisis began, and they started hiking rates late, you can see here that we did not see them raise rates to the same extent that some of these other central banks have. And so when they're cutting interest rates ahead of the Fed, then that gap that differential just serves to increase further. But of course, we've been in a position where everyone's been expecting the ECB to cut interest rates for a while now, but people have been concerned around the consistent pushing back of expectations for the Federal Reserve interest rate decisions. And so the question mark here is, given the fact that people are now feeling more confident about that September rate cut from the Fed, does that sort of weak euro story reverse? And that's something that has been playing out. If we look at euro dollar, you can see here in terms of the sort of wider picture that, let's just go full screen there. So from a daily time frame, you can see this downtrend that's been playing out over the course of 2024, most recently rallying back up into trendline resistance. We've got this 109.16 up ahead of that, and essentially you've got this creation of lower highs that really could be tested in the near term. The question mark here is, number one, do we see this move towards cutting interest rates from the Federal Reserve? And number two, what's the signal coming out of the ECB? Are they, well, number one, they could cut interest rates this time around. But if they don't, are they going to lay the groundwork for that September rate cut? And do we see the Federal Reserve doing the opposite? Of course, we have got that appearance from Jay Powell, and that comes off the back of that CPI release. Those two appearances in Washington for the week just gone were prior to the CPI release. So do we see a change in tone from Jay Powell where he points towards the possibility of a September rate cut and he feels more confident about that? Well, if that comes to fruition, we could see this recent uptrend on an intraday basis continue apace. And you can see here that sharp rally that we saw around the CPI number pulled back to some extent. But then we saw consolidation, and now we're looking like we could then leverage that to push higher once again. This looks to me like a sort of 50% retracement. Let's just grab that on and see exactly where we came. So yeah, 50%, a little bit deeper than that, close to the 61.8, but not close enough. So somewhere between the two. So we've seen this pullback, then consolidation, and now pushing up through this near-term resistance level of 108.7. That gives you that little double bottom formation. Probably look a bit more normal on that 15-minute chart. So double bottom following that 50% retracement, and we're starting to push higher once again. So I think there's a good chance that we do continue on this current vein. Certainly if we see that story around the ECB cutting rates, but the Federal Reserve not reversing into both of them cutting interest rates, well, that is a good news story in terms of markets as well, and the potential for weakness for the US dollar as a result. And so we could see further upside, but bear in mind, we've got this descending trend line in play here, and we need to see a break through that 109.16 level to negate the downtrend that has dominated 2024 thus far. Next, I wanted to talk to you about the UK. We can see here inflation data coming out on Wednesday, but we've also got on Thursday the jobs report, on Friday the retail sales number, and the GfK consumer confidence number. So the UK economy really will come into the spotlight at the back end of the week to come. What's notable here is the UK has already hit 2% on that headline CPI number. So all is well, right? So the Bank of England can just cut away. Well, possibly, but then you look at that core inflation reading, 3.5. We're still some way away from a return to target on that front. So it really just depends on the appetite for the Bank of England to start cutting interest rates, because they've got the excuse to do so, but they've also got an excuse to hold off. In terms of the jobs market, unemployment rate expected to remain relatively low at 4.4%. Average hourly earnings expected to decline to 5.6 from 5.9. That would be a good news story if we continue to see that downside move in terms of average earnings. Of course, that wage pressure is sort of underlying inflation, essentially. And that's the kind of thing that will feed through into your inflation rate, but more notably, your core inflation rate. Retail sales, look, ultimately, retail sales generally are very volatile on a month-on-month basis. So certainly worthwhile taking a look at that year-on-year figure, expected to decline marginally down to 1.2%. Now, if we look at the UK inflation picture, we can see that the trend is a positive one for the Bank of England, right? I mean, we saw that massive rally up into double digits across both RPI and CPI, but we have seen an almighty collapse. It's pretty much come down as fast as it went up in terms of headline CPI in particular. And we're seeing this more gradual move towards the downside in terms of core inflation. So here's the breakdown in terms of core, because arguably you can say that, you know, even if we did see an uptick in terms of headline CPI, we're still around the right area, right? But it's that core inflation metric that if we saw significant disinflation on that side of things, then people are going to feel really confident that the Bank of England have no reason to hold off at all, and that they'll be able to cut rates in a pretty dramatic manner. Well, unfortunately, all of the big inflation that has happened over the course of the past 12 months has happened in the last 4 months, essentially. You can see here February, March, April, May, massive inflation. And that is highlighted by that 6-month annualized figure at the bottom of 4.62. So if the next 6 months play out just like the last 6 months, then we'll be at 4.5%. Essentially, we won't be at 3.5%. And so that highlights the fact that we really need to see these monthly inflation metrics come down in a meaningful manner. You might look at that headline CPI number and say, great, we're at 2%, everything's fine. But anyone that looks at the month-on-month core CPI numbers will say, look, you know, on the last 4 months alone, we've pretty much hit that 2% target. So there's significant risk if we don't see this monthly inflation come down in a meaningful manner. 0.455 was the last one, and that was a significant decline on the prior month. In terms of what's being stripped out is 0.205. That would be the lowest reading in, you know, 4 months. Well, the last 4 months would have all been higher. So if we come in even flat at 0.2, that would be a good news story, quite frankly. But it wouldn't do much by way of disinflation on that headline 3.5 number. So I think it's going to be difficult. If you look at the pathway back down to 2%, I think arguably we're probably more likely to rise more than fall over the course of the next few months. But certainly looks likely that we're probably going to be treading water in terms of the core CPI number. And so it's down to the Bank of England. Look, do they want to cut interest rates at core CPI at 3.5? If they don't, they might be waiting a fair amount of time, basically the best part of a year, before we actually see a return back down to that 2% target. So worthwhile looking out for that month-on-month core CPI number in particular. If we see more, you know, 0.4, 0.5, 0.6s, it's not good news, quite frankly, because we're just really stacking up some heavy inflation numbers. And as those sort of lowly figures from last year start to drop out, if we don't start seeing this month-on-month inflation coming down in a meaningful manner, then we could see core CPI really diverge in a very meaningful manner from that headline inflation metric. Now, in terms of what we're looking out for, this is the FTSE 100. And we can see that by and large, the trend is a bullish one. We're looking at the weekly time frame here, and you can see, you know, the recovery here from COVID has been a gradual one. More recently, seeing this very strong move towards the upside at the beginning of this year, pulling back from the peak in May. Now, essentially, we're sort of what I would say is bottoming out. I don't necessarily know that it's bottoming out until it's rallied up from that, but you can say that we've seen this very strong rally that isn't sustainable, quite frankly, and so that was likely to see a pullback at some point. That's exactly what has happened over the course of May, and then June was all about consolidation. We've essentially been moving sideways, and so we're going to look here at this 8297 as the key bullish breakout signal. If you look at the bottom end of this pattern, we can see that essentially the trend is for lower highs turning into don't really want that ray, but anyway, let's just leave that for now. So we're essentially going like this, right? Excuse the ray. So we're bottoming out in the sense that we're now creating higher lows rather than lower lows, but the top end, we're sort of flatlining here. So the key thing is a break through 82.97. If that happens, then we'll be looking at this most recent swing low as the area beyond which a bullish view is held. So essentially, if we rally up through this level, then we'd have to break the 81.32 to negate that, because we've got this sort of bottoming pattern, and then the projection would be a move back up into that prior record high. It's notable that we did see weakness yesterday for the S&P 500. but strength for the likes of the Dow or the likes of the equal weighted S&P 500. So essentially, we're seeing optimism within markets, but it's not necessarily being reflected in big tech. That can be good for the likes of the FTSE 100 because, of course, this is often a relatively unloved index. And certainly when you've got those big tech names soaring over in the US, why would you be long the FTSE when you can be long the S&P 500? Well, when the S&P 500 is seeing weakness, let me just get the comparison between the two. When you're seeing weakness in terms of the S&P 500, but strength in terms of those sort of middly names, then you're likely to see some strength for the likes of the FTSE 100. So this is the S&P 500 compared to the FTSE 100, or the inverse of that. Essentially, the FTSE decline here in relation to the S&P 500. So long term, it's all about US stocks rather than the FTSE. We've seen a little bit of a rebound here as we saw that US CPI number seemingly benefit cyclical stocks over big tech stocks. Whether that's going to be long lasting remains to be seen, but certainly it's a little bit of a story around people potentially looking for value within markets where we're seeing stretched tech names, and that could be beneficial for the FTSE 100. So look out for a move through 82.97 for a potential bullish signal, in particular if we see disinflation continue in terms of the UK inflation picture. But keep an eye out for that monthly core CPI number, because that to me is a cause for concern. And finally, I wanted to look at the likes of the Australian economy and the New Zealand economy. Anyone that follows my videos will notice that I like to pair the two, certainly when it comes to Aussie Kiwi, in part because of the fact that, you know, they're very highly correlated markets, and therefore any differential in terms of interest rate probabilities or expectations allows you to strip out some of the other factors, such as risk on, risk off kind of moves that you might see if you put a US dollar into a currency pair. What's notable for this week, of course, is Thursday. Thursday sees the Australian jobs report coming out, expecting to see the employment change number decline, full-time employment decline heavily, part-time employment increasing heavily. So not necessarily a great news story there. Unemployment expected to remain at 4%. But the key thing here is going to be that New Zealand inflation rate, and the signal of why this is so important might be lost on some people. But we can see at the bottom, the inflation rate is quarter on quarter. It's not month on month. We do not get monthly inflation data coming out of New Zealand. We have to wait 3 months at a time. And that's why I have a messed up chart whenever I try and compare these different areas, because the New Zealand one, as you can see in the light green at the top, we have to wait ages before we see the new number. So it's at 4% according to the last figure. And you can see right here at the bottom, that year-on-year figure of 4% expected to decline to 3.6. That wouldn't necessarily fill us with too much confidence, because like we said, UK core CPI is at mid threes and we're not feeling great about that. So why would we feel great about the fact that year-on-year inflation in New Zealand could be at 3.6%? Well, the reason why is because if you look at the expectation for a quarter-on-quarter figure at 0.6%, of course, if that's a single quarter, you expand that out over the course of the year, and you're looking for the potential for 2.4% if we saw every quarter of the year looking like that. So if we look in terms of the breakdown for New Zealand inflation, we can see that the last 2 quarters were actually pretty good, right? So 0.64, 0.48. So essentially, if we see another reading come in at 0.6, then the last 3 reports would have come in at around about 1.5, right? A little bit more than that, 1.5, 1.7, 1.6. Not too far from target, right? So that means that in a quarter's time, if we see again something akin to the 3 quarters prior to that, something like 0.6, then you're likely to see New Zealand inflation in the low 2s. And the reason why we've got this highly elevated year-on-year figure is that 1.79 figure that we can see a few quarters back. Once that's stripped out, we're going to see a massive collapse in terms of New Zealand inflation, and the RBNZ will know that. Now, bear in mind that we've only just seen the RBNZ interest rate decision. They kept rates steady as expected, but the key thing that came out of that was they essentially stripped out any commentary about a potential rate hike, and they're feeling increasingly confident that they're going to be able to cut interest rates this year. That is in stark contrast to the RBA. We do not expect to see the RBA cut rates this year, and there are question marks about whether we might see interest rates in Australia rise. And so there's that differential that's playing out. If we see a nice low quarter-on-quarter figure for New Zealand inflation on Thursday, we could see further weakness for the New Zealand dollar against the Aussie dollar. In terms of the chart, here it is. We've seen this lovely rally of late, pulls off the back of this 61.8 Fibonacci level, and it's taken us into this area that we've seen these prior peaks, right? So May 2024, June 2023, and February 2023 have all seen significant peaks around sort of 1.105 to 1.109, right? And this time around, we've managed to break through that level. If we sustain above that level, we've got plenty of room to play with without any major resistance at all. So it does provide the basis for further upside. You can see this rally up through that level, consolidating. This is off the back of that RBNZ meeting. We've seen consolidation here. We tried to pop, we pulled back a little bit once again. But I think there's a good chance that we do see the bulls coming back into play. And certainly this inflation gauge from New Zealand will be absolutely key. We waited 3 months for it, and it's looking like it's again going to come in with a very nice number that puts us on track to potentially see inflation come back down towards that 2%. I don't think it will hit 2% this year, but towards that 2% to justify the RBNZ cutting interest rates, because they'll say, well, we're on a path to 2%. So pulling back a little bit, but unless we break the 1107 level, I think this pullback is likely to see the bulls coming back into play once again. And if that happens, then given the break up through this near-term resistance level, or I say near-term, this resistance level established over the last year and a bit, then it does provide the basis for significant upside and outperformance for the Aussie against the New Zealand dollar. Bear in mind, though, we are at this big key resistance level, and there are always potential fake outs. So if we see a strong New Zealand inflation gauge, we could see this rolling back once again from this resistance zone. But personally, given those expectations, if we see something akin to what's expected in terms of that 0.6 number, I think there's a good chance we see Aussie Kiwi moving towards the upside once again, following yet another strong week of gains. We've seen 1, 2, 3, 4 weeks of really strong gains here for Aussie Kiwi, and I wouldn't be surprised to see more of the same for the week to come.